Mortgage rates are currently approaching 7%. Is it possible to get a loan interest rate at 2.25% in today's market? Does that sound too good to be true? Well, that's the subject of today's video, and we're going to get started right now. Hi, my name is David Matney with Nebraska Realty. I'm a local realtor here in Omaha, Nebraska. Now let's jump into today's topic. Today, we're going to talk about one of the hidden benefits of VA financing, and that is the VA loan assumption. VA loans are loans available to qualified veterans. What people may not realize is that VA loans are assumable. What does it mean when I say a VA loan is assumable? That means a qualified buyer is able to take over an existing VA loan from a veteran. What does that actually look like? Let's say you purchased a home back in August of 2020 for $415,000. You take out a 30-year VA loan with an interest rate at 2.25%. What does that look like in terms of monthly payment? You have a purchase price of $415,000. You're coming in this example, with 5% down payment or $20,750. The loan amount is $394,250. That means your monthly payment at 2.25% would be $1,507.01. Now keep in mind, with VA financing, it has to be owner occupied. Also, you can buy a home with VA financing with no down payment. However, in this case, you came in with a 5% down payment. 3 years later, you decide to move, and now your home is worth $510,000. And your loan is now paid down, and now you have a loan balance of $380,000. How does the VA assumption work? You have a purchase price of $510,000. The buyer would come in with a down payment of $130,000. That means the loan amount, which they're assuming, would be $380,000, and the monthly payment at 2.25% would be $1,507.01. And that's principal and interest, and that's for the next 27 years. What about mortgage insurance? The nice thing about VA financing is that there's no mortgage insurance premium. How long does it take to do a VA assumption? It takes a little bit longer. You want to plan for at least 60 days minimum. And this is huge. What if I'm not a veteran? Can a non-veteran assume a VA loan? And the answer is yes. And that's a big advantage with buying a home with VA financing. The seller has a certificate of eligibility. If a non-veteran assumes a VA loan, then the veteran loses their certificate of eligibility. However, if a vet assumes the loan, then the seller can take their certificate of eligibility with them. How much would you save by assuming a VA loan? Okay, let's look at a purchase price of $510,000. And in this case, just to keep the math the same, let's say you're coming in with a down payment of $130,000. Your loan amount would be $380,000. However, instead of that 2.25% interest rate, you're at the current interest rate at 7%. That means your principal and interest payment would be $2,528.15 per month. In this case, the buyer would save over $1,000 a month by assuming the VA loan. Now, in our example, it's important to note that in order to assume the loan, the buyer would have to come in with $130,000 cash, and the buyer has to be approved with the seller's lender. Now, this is just a simplified explanation of the overall process. You'd want to speak with your mortgage professional for more information. And if you're currently in the market and you're buying a home, you might want to ask the seller or find out what type of financing the current seller has. Because let's say they have VA financing, then you may have an opportunity to assume that existing VA loan. And if you want to learn more about the home buying process, be sure to check out this next video, and you make it a great day.